Mind-blowing is a term thrown around a lot in tech, but Palantir's Q4 2025 earnings call actually lived up to the hype. We aren't just looking at a beat and raise, we are looking at a company recalibrating what growth looks like for big cap software. Total revenue hit $1.41 billion, up 70% year over year. The real fire is in the US commercial sector, which exploded by 137%. Alex Karp basically took a victory lap, calling these the best results in tech over the last decade. They've moved past the rule of 40 and are now operating at a rule of 127, a combination of growth and massive margins. Their AI platform, AIP, has turned into a revenue machine, closing 180 deals over $1 million this quarter alone. So, if the numbers were that insane, why was the stock only up 11% pre-market? These results would trigger a 30% moonshot. But Palantir isn't a normal stock, it's a priced for perfection stock, trading at a forward PV ratio north of 170x. When you're valued that high, the market expects you to not just beat expectations, but to perform literal miracles. An 11% jump is the market admitting it was surprised, but it's being capped by a few things. The get out at even crowd. The stock dropped 30% from its November highs. Traders used this 11% pop as an escape hatch. The international lag. While the US is on fire, international commercial only grew 8%. The bears are arguing they'll hit a ceiling. Profit taking. In this 2026 macro environment, institutional investors are quick to hit the sell button on double-digit overnight gains. Now, despite how impressive that call was, and it was spectacular, I am not buying Palantir at this price. Here is the reality. Investing isn't just about finding a great company, it's about the price you pay for that company. At a 170x multiple, you aren't just paying for today's success, you are paying for the next 5 to 10 years of perfect, flawless execution. I look at that 8% international growth and I see a massive question mark. If the AI revolution stays concentrated in the US, Palantir will eventually run out of room to justify this valuation. Furthermore, the bootcamp strategy is brilliant, but it's labor intensive. Can they scale that indefinitely without margins taking a hit? For me, the risk-reward ratio is skewed. I love the tech, and I respect what Karp has built, but I don't like buying into a nosebleed valuation, where even a slight miss in the next 6 months could result in a 40% drawdown. I'd rather wait for a better entry point or put my capital into companies where the market hasn't already baked in a decade of perfection. I'm happy to watch this one from the sidelines for now.